Nigeria Central Bank Monetary Policy Committee has raised the country's headline interest rate some 400 basis points to 15.5% since 2022 started, as the financial regulator chased inflation, reading 20.5 in the month of August. The financial regulator also jacked up the cash reserve ratio of banks to a minimum of 32.5%, with compliance deadlines set for tomorrow, Thursday. Joining me to discuss the facts behind the rate hikes as well as what lies ahead is Dr. Mahmud, Director in charge of Monetary Policy at the Central Bank in our Abuja studios, and also chatting to me on what the message for the market is in getting the MPC rate increases. Nwizu is a co-managing partner at Comercio Partners. Nwizu is here with me in our Lagos studios. Gentlemen, good evening. Let's get started with you, Dr. Mahmud. Many thanks for coming in through. What are the underlying issues for Nigeria's inflation that requires aggressive rate tightening of 400 basis points by the MPC since 2022 started?
Thank you, Watson. Yes, two fundamental issues. We've been tightening. This is the third tightening by the monetary authorities. However, what you see over the period that necessitated this aggressive policy measure in terms of the 100 basis point increase in MPR was largely driven by the trend in inflation numbers. Month on month for the last close to 2 years, we have inflation numbers going up except for January 2022. However, the trends has been around 10, 20, maximum 25 basis point over this 10, 15 months period. From May 2022 to August numbers that we saw 20.5, we had close to 200 basis point increase in inflation number. That was phenomenal. And it needed to be addressed very quickly. And there are also forecasts that this trend is not abating very, very soon, given that the factors driving this trend are still, pertinent and are persisting over time. So monetary policy needed to take immediate action to bring down this inflation number by using the most potent tool that is available now. Don't forget that there are a lot of other global headwinds that are also impacting on the domestic inflation numbers. There are a lot of also pass-throughs through other. The dollar is appreciating because the Fed is also tightening. It has increased rates.
Yes, Dr. Mahmud, thank you for explaining the inflation reading there very quickly. Let me ask you, Nnamdi, about your understanding of inflation that is so scary right now in the domestic space for the Monetary Policy Committee members to decide, look, we did 100, we did 50, we did 100, then just move back to 150.
Well, I mean, if you look at what inflation figures are right now, we are looking at, I think, about 20% or 20.5% the last reading, which is, I mean, one of the highest inflation figures we've had in Nigeria, at least the highest in the last, about 20, 30 years or so in Nigeria. So it's extremely high. And then the truth about it that most people would say to you that that isn't even the real inflation figures, because if you look at how the prices of things have gone up over the last, I would say, 6 months to 1 year, there are a lot of items that have gone up by what, 60, 70, 80%, 100%, right? So even at 20%, I guess looking at the baskets, there are a lot of things that pull it down. But for the common man on the streets, that's a huge number. If you look at the US, where inflation peaked at 9.3%, you saw the Feds raising rates aggressively, everybody worried. So now imagine what it is for the common man on the streets. And the truth about it is that your employers are not increasing salaries, because not as if the economy is exactly great right now.
Yes, so I was just ask about the GDP, the about 3.5% we're doing. That's not, does it look like the MPC is comfortable with that growth rate?
Well, so I think the MPC has basically looked at it and said, look, what do we prefer? Do we prefer to have high growth in GDP or continue to have high inflation, which is exactly the same thing you see happening in the US. And I think they decided that inflation is more of a risk right now than the growth trajectory, because the economy is growing at a faster rate than they had expected and forecasted, right? 3.54, but naturally this will most probably slow it down a little bit. Yeah. But the truth about it is inflation is a bigger threat at this point in time than looking at the growth in GDP.
So inflation has a greater threat. How much threat is higher inflation really to even GDP growth as we have it?
I mean, considering, first of all, you have to look at what MPC has done, which is raising rates, right? So first of all, what that would do most probably slow down your GDP growth a bit. So maybe you might see GDP at the end of the year coming down to maybe between 2.8 to 3% growth. That's the first thing. Then the second would be when the common man on the street struggles to feed, right, disposable income starts to reduce because of inflation. Now, when that happens, what you see would be that the economy as a whole naturally would even slow down. Even if you look at currency alone, as long as you continue to have a depreciation or devaluation of your currency, right, then what will happen is that people would rather take their funds here and continue to invest in US dollars versus investing in Nigeria. You would also see a slowdown in growth across various business segments. Manufacturing, the banking sector, all sorts of things. People will be a bit unwilling to invest. Reason being that there's a limit to how much the manufacturers, for instance, can pass on the inflation that they're feeling.
Inflation.
Yes, on their goods. There's a limit to how much consumers will be willing to pay.
So how has the financial market reacted today to this latest development?
Well, so first of all, we've seen yields move up pretty aggressively. We had the last one-year T-bill auction, which closed at, I think, 9.75 at the last auction. Today closed at 12%. So that's a 225 basis point rise.
On today's NTB auction by the central bank?
Yeah, NTB auction by the central bank. So the 1 year jumped up by 2.25%, which is a big jump, so it closed at 12%. If we look at the bonds market, we've seen bond yields move up roughly about 80, 100 basis points today on the back of, the MPC actions. And then, yes, as much as we saw that the equity market moved up a bit, if you go and look at the banking names, for instance, you see a lot of them struggle today in terms of prices and co. So we've seen equity market isn't, and naturally we know that they won't respond so well to higher, interest rates, right? Yeah, so...
So in terms of the liquidity ratio, the cash reserve ratio as well, do you think this 32.5% level, what impact will it have on banks and those and available liquidity for everyone to invest in government treasuries and government gilts that would definitely yield higher with this higher MPR?
So first of all, MPR, CRR used to be, with cash reserve ratio, used to be 27.5 and it was increased to 32.5. But most banks have much higher CRR ratios based on the way the central bank computed. And if you notice, this time, the CBN governor said minimum CRR. Typically, they would say to you, CRR is X. But the phrase minimum is a new introduction. And that's because there are banks that have 60, 70% when it comes to their cash reserve. So for the banks already, a lot of them are crying. They're being squeezed when it comes to liquidity. And this is definitely going to negatively impact them, even in terms of their ability to make money, profitability. Because, look at it, for every 1 naira you bring, for those that have 60% CRR, for every 1 naira you bring in, central bank will take 60 kobo out
of it.
So you only have 40 kobo left to spend. So that gives you an idea of what kind of impact it has on them, and then the kind of impact it has even on manufacturers and people who want to borrow from banks because they have less liquidity available to give out.
Unless you have a cash cow, you are cash cow companies in the breweries, telecommunications.
Yeah, or unless you're looking for dollar loans, because CRR doesn't affect dollars, dollar balance sheet. It only focuses on the naira balance sheet. So that's the liquidity that they're trying to squeeze out. So that's definitely going to have an impact on them, have an impact on their profitability, and also have an impact on their ability to create new loans because they have less liquidity. And for the government, it's going to make it more expensive for them to borrow, right? Because first of all, the banks will reprice. We've seen them reprice treasury bills to 12%, more expensive for government to borrow. And, we have ways and means, which is central bank lending to the government, which is about 18 trillion, the last figure that I saw. And they lent them at MPR plus 300 basis points. So that means previously it was 17%, now it's going to be 18.5%. So even the cost of going to central bank keeps increasing for government. Cost of coming to the market keeps increasing. So even when you look at your ratios and you look at your debt service to GDP, you're going to see it's going to get worse. And
So 3 to 6 months down the line, what's your outlook right now in terms of how the financial access? This is effectively wrapping up the year in the manner of speaking. Unless anything anything comes out of the blue for the last MPC, which will be November, December to wrap up the year.
Yeah.
So what's your permutations in terms of how this will impact market development to the end of the year? What happens to my financial assets for the year, as it were?
Well, so
400 basis points in 1 year.
Yeah. So first of all, we're going to see bond yields go up, so which makes it more attractive for people to invest. We are going to see the plan is part of the plan would be to make the naira more attractive, so you have less people moving from naira to the dollar. So if they continue to increase rates and they continue to squeeze the bank's liquidity, you would see naira rates jump up, which might help slow down, the movement or the trade now that people are doing, which is basically converting naira to dollars to go and invest. If you were to look at the Nigeria Euro bonds, for instance, today trading at about 15%, right? Which is even higher than where you had the local bonds trading. It's a no-brainer for most people. Convert your naira to dollars and go and invest offshore. So we might see, so on the macro side, we intend to see higher cost of borrowing. We intend to see higher cost of issuance. We intend to see, most probably, we believe we'll see a slowdown in GDP, right? And then inflation might still continue to go up in the meantime because some of these things take time. And as you're slowing down on the demand pull inflation, but you're increasing from the cost push inflation side because cost of manufacturing will go up, right? Cost of producing goods will go up. So you're going to see people who manufacture and all sorts of things start to complain because the banks are going to increase lending rates to them. The more they get squeezed, the higher the rate, the higher the cost of naira, like I explained. So if you have 60 kobo going out for every 1 naira you bring in, you're going to increase your cost, right? So you're going to most likely possibly see some sort of slowdown in lending activities, and you're going to see most probably continue to see maybe an increase in prices from the cost push inflation perspective.
Will the banks be squeezed this year in terms of their balance sheet?
Well, we already heard the central bank governor say he's going to debit them on Thursday. Now, people are not sure what the figure is.
That's tomorrow.
Yeah, that's tomorrow because you have the regular CRR, which is now 32.5. Then you have what people term discretionary CRR, which is why some people are at 60%, 70%. We've had some banks at 100% in terms of CRR figures, right? So almost all their now deposits have been taken. So if that happens, you're going to continue to see the banks, struggle. It doesn't shrink the balance sheet per se because, the funds with central bank would still report on their balance sheet, but it most probably would have an impact on their profitability. But in the long run, if you have higher yields, then the banks getting new funds can reinvest those funds at higher rates, which, will speak well for them and speak well for their profitability in the long run.
You folks at Comercio Partners have a number of your financial supermarkets. You've got equity side, fixed income, high net worth individuals you're dealing with and all of that. So I'm sure since yesterday you've been receiving phone calls and you folks are What are investors asking? What are they worried about right now with the current state of interest rates?
Yeah. So for them, the question is, will this actually, rein in inflation? That has been one of the big worries that they have. Or is it just going to make it more expensive for them, for those who are not just on the investing side, but you have those who have businesses to run and who also need to access, because even if you look at the advisory side of the business, for instance, you have those who need to access debt, and they're saying to themselves, this is going to make it more expensive for me to be able to access debt. Should I hold on this offer I want to come out with? Should I look for an alternative? Maybe I should think about getting equity instead of getting debt because it suddenly looks like the cost of debt is going to jump up, right? A lot of people are surprised that they tinkered with CRR because, like I said, you already have banks that are at 60, 70% CRR figures, 40%. So people didn't expect CRR. That was, so what's the thinking? Are things that bad? Is there something the central bank is seeing that the rest of us haven't seen that has made them decide to go the route of squeezing more liquidity? And the thinking is around the currency, right? Because
perhaps elections.
They need to find, the currency and then trying to rein in, I think, government spending.
Or political spending.
Or political spending, yes. So it might be either of them. But for the currency perspective, they want to make Naira more attractive. So people stop moving from Naira to dollars, yes, to dollar assets. And then on the spending side, it makes it harder for people to access Naira, be it government, be it politicians or whatever it is. It makes your Naira more expensive, makes liquidity less available, right? And then if somebody comes to meet you as a bank, for instance, you're going to have to decide, do I want to give my money to those who are focused on political spending, or do I want to give to the real sector, energy sector? What sector do I want to avail the smaller pool of funds that I have at this point in time?
So, broadly speaking, for the macro, the economy moving forward between now and the middle of next year or so, when we're looking at the new administration, what's your permutation? It's going to be really tough.
I believe it's going to be tough. We're going to have, quite a lot of liquidity should come in, which basically will be election spending, which I guess is also a part of the reason why CBN is trying to front-run that, to try and mop up that liquidity ahead of time. But inflation, hopefully with all these raises they've done, maybe we see things start to calm down by the time you get into Q1 next year. But it's possible that we still see the central bank raise rates at the next MPC. You've heard them say it, as long as inflation continues to go up, they can't guarantee anyone that they're going to stop raising rates, or they're going to stop tightening.
Very, very interesting time. Nwizu, let's give you just a very few minutes of a breakout. Let's get Dr. Hassan Mahmud, the Director of Monetary Policy at the Central Bank, back into the conversation. Thank you so much for coming back on the line. Thank you so much. We lost you momentarily there, Dr. Hassan. Tell me about the delicate balancing that the central bank faces in terms of credit and economic growth versus inflation targeting on the other hand.
Yeah, thank you, Bolson, and sorry for getting out earlier. I think the balancing is skewed into purely focusing on inflation now. The essence of the delicate balance post-COVID was the fact that the economy was in recession. You have to bring the economy back to steady state, kind of above the waters, and have positive growth. So the emphasis was driving the supply side and getting growth back to at least the recovery street. We've gotten to about 3.5 GDP growth rate now in the last quarter numbers. However, the pace at which inflation was going was something that is a lot alarming, and that has to be tamed, so that even the consolidated recovery that we had will not be eroded with this price effect. So and it's also known now that there are a lot of monetary factors that are also driving this inflation, apart from these structural or legacy structural issues that we mentioned. The injections that came post-COVID, the tightening that is going on in the United States, the government spending, all those are also building up. So when we talk of this excess liquidity, it's more in the banking system. And we need to also use the monetary policy rate, which is a signaling tool for the behavior of this banking system, to drive that liquidity out of that system so that rates will start picking up. It has its own side effect on the rest of the economy in terms of cost of credit going up, hardship also picking up, but there's always a price to pay, and there's always a trade-off. So we needed to just get these inflation numbers down so that disposable income will even have some meaningful purchasing power to be able to drive, the sustained output growth that we have seen over the time. So the balancing, the monetary policy authorities made it clear in the last communique that the primary mandate now is to, tame inflation in the line of this price stability mandate. And doing that aggressively now means that we'll slow the pace at which the inflation numbers will go. The forecast is still that inflation numbers will still go up in the next month or so. But there's also a lag effect of this outcome of these policy measures. So we're also mindful of that lag effect and seeing how the outcome will be shortened in the sense that before the end of the year, you start seeing, a kind of moderation, even if not a direct decline, moderation in the growth of that inflation numbers.
Okay, so there's a report released today by Alliance Trade, which talk about inflation, globally speaking, and across Africa. And it's saying the inflation outlook for Africa, for Nigeria, outlook for this year will be 18% and 15% for 2023. On average for Africa, sub-Saharan Africa will be around 14.7%. So that's the outlook today in this particular report. But again, at what level of inflation will the central bank or the MPC think that, look, we need to start slowing down a little bit in terms of rate hike? We think this figure, we can work with this figure so we can decelerate on rate hike, and we can begin to see whether we need to cut or to do something else without necessarily raising rate. Is there a discussion around that at some point?
Yes, of course. There's a lot of discussions around this. Traditionally, the threshold is a single-digit inflation numbers. However, from the models that are also used within our research group, we have the threshold of where we see that at that threshold, at that benchmark, inflation beyond 10, 12, 12.5% is definitely inimical to growth. These were numbers we had pre-COVID or pre the 2016 crisis. So by the time the numbers start going below 15, getting to 12, getting to 11, and then you start seeing that moderation. But from the trend we've seen now, even if we start seeing the numbers going below 20, 18, 19, month on month, then you start seeing that, yes, the policies are having impact. So there will be a period, a signaling time that you will start, moderating this tightening. But even at the stage at which they are now, even if monetary authorities hold is still a tightened position, don't forget that they added the CRR into that space. And so that is also a major tightening policy tools that has been adopted. So the options are all dependent on the outcome and the speed of how we see what we call optimal expected outcome.
So between the MPR at 15.5% and CRR at 32.5%, you're locking everybody in, or perhaps you're locking everybody out. Perhaps that's more like it.
You see, there are two segments of the equation, Bolson, that we have to look at here. One, the banking system. That banking system, that is where monetary policy tools are being deployed or implemented to impact the rest of the economy, the investors, households, and firms. While there is excess liquidity within the banking system in terms of how we measure the balance sheets and or all the liquidity instruments that we put in there, we see excess of this liquidity there. This excess liquidity is one, muting the growth in money market rates, which is good for investment and attracting savings. It's also impacting on pressures on FX, which also feeds into the depression of the FX, which in return gets into the inflation numbers going up. So to ginger that process, you need to, and don't forget there's also the issue of pent-up demand following the excess injections that we had, the fiscal and monetary injections to cushion the effect of COVID. So you have all those built up, and that's why I said a monetary phenomenon is playing a big role here. And monetary tools are best adopted for monetary phenomenon than the structural phenomenon that we were dealing with in terms of the interventions we were doing. So there was a need to pull all this out of the system, which is the banking system, not the general economy now. Pull this out of the system, hold that down, kind of sterilize it within the central bank space, so that rates will start picking up, and then reduce this pent-up demand that is giving pressure. It's kind of demand pull inflation. It's giving pressure to this. Let's even discount the external shocks. Domestically, we needed to take those policy measures quickly to slow down this place. Otherwise, the gap is widening. We are looking at the inflation numbers, and we're also looking at the MPR. MPR 15.5, inflation at 20.5. You see over 600 basis point gap there. That's a negative real interest rate margin that needs to be narrowed. For you, one, not to have this threat of capital flow reversals, and two, to also retain or attract new capital into that system. That is one bucket of this. The other side of it is the cost of credit to the households, to the farms, to the businesses, which is a genuine concern. And that the communique has also mentioned in the governor's speech that, well, we had these injections of over 9 trillion in terms of the interventions that are single digits. Most of them are long-term. Don't forget that commercial banks cannot give long-term loans, but these are long-term facilities, 5, 7, 10 years with 2 years moratorium. So you are seeing some lag there for them to be able to start their businesses. If those start yielding results and you see output growing, then you see that also the supply side also bringing down those inflation numbers. core inflation is a major driver of these numbers that we're seeing, which is coming from energy prices, which also has its own implication for the
very interesting, very
so looking at.
Yeah, please go ahead, quickly, Rano. We have just about less than a minute. Dr. Hassan.
Yeah, so there are trade-offs, there are compromises that has to be done. Some costs will be borne by some side. What is important is balancing that cost, the cost-benefit analysis. At the end of it, what will be the overall welfare effect for the entire economy? I think that is the brain behind the entire system. There is no policy tool that you will take. Even if you loosen, there's also going to be a cost implication. There will be those that will lose out of that space. But what's important is what is the ultimate, most efficient outcome that is, more inclusive for every sector of the economy. And that is where to go. So that, because inflation impacts more the poor and the vulnerable than even the tertiary sector that we talk of in terms of the big investors or the commercial or banking system. So balancing that is using the tools within which the monetary authorities can
a very delicate and a tough one. Thank you so much, Dr. Hassan Mahmud, Director, Monetary Policy at the Central Bank of Nigeria, and Nwizu, Co-Managing Partner at Comercio Partners. Thank you very much, gentlemen, for coming here tonight. I'm sure this is a very big conversation still ongoing.